This is Scott Becker with the Becker Private Equity and Business Podcast. Thrilled today to be joined by a brilliant investment banker, business person, investor, David McCombie. David will tell us about himself, the McCombie Group, his background, and a lot more. David, can you take a moment and tell us about yourself and about the McCombie Group? And thank you for joining us.
Sure, thank you. So I am a reformed attorney. I formed the McCombie Group almost 14 years ago, and we're focused on improving, growing, and selling middle market businesses. And I'm also the author of the upcoming book, the Selling Your Business with Confidence, the playbook for mid-market owners.
And talk about that. How do you define mid-market? How did you transition from practicing law for consulting? I see at one point in your background as well, to ultimately investment banking. And did you ever practice law, or did you go right into business?
So interestingly, I'm licensed, but I never actually practiced law. I worked for McKinsey & Company straight out of law school. And I did do some investment banking prior to that, but it's a little bit more serendipitous in terms of how I ended up, forming this. I started more as an investor. Most people go from investment banking to private equity. I went the opposite direction. And it was primarily because as a value investor, I felt that, if you can't beat them, join them. Quite frankly, my business has really taken off when I, shifted more towards, the sell side. In terms of how you define, the middle market, you probably have, asked 10 people and you've got 10 different opinions. We think about it as businesses that are, bigger than mom and pop. They're, real businesses. They have, enough infrastructure that they're probably larger than just the founder and entrepreneur. I personally define it as 10 million to about $1 billion of revenue. But, if you look through the investment criteria of lots of different private equity funds, they set their thresholds, all across the board.
Thank you. And what are there specific industries that you're focused on, or more generalist? How do you approach the market? How do you approach what you look at?
Yeah, so we are a generalist, but we're based in South Florida, and really over 50% of our work is in healthcare services. South Florida really has been an epicenter of innovation in particularly the Medicare Advantage market. And so you see a tremendous number of both primary care practice groups that have come out of here, but as well a lot of different specialty practice groups that end up becoming platforms for a lot of private equity funds. What we find, from an industry standpoint, I personally was born and raised here in Miami. It was important to me to be able to be a part of the community. And so being deep within the community, but industry agnostic, was something that I found was a much better fit for me and, my, lifestyle.
No, 100%. And more on the practice platform provider side, or also technology that sells into healthcare providers. Where do you see yourself? What's keeping you active today? What's most interesting today?
So right now, we've got 4 different healthcare service businesses, in the market. We've got a home health agency. We have a specialty physician group actually in the cardiovascular space. And we have 2 different, primary care physician, groups. So kind of across the board, all of them right now are on the clinical side. We have done, a decent amount of work of, technology to the healthcare world, and other ancillary services. What we don't do is stuff in the life sciences. The reality is that the level of kind of science and all of that is really above my capabilities. And so we stick to the core knitting of stuff that we feel we can deliver, excellence to our clients with.
And let me ask you, in terms of the cardiovascular space, the primary care space, will health systems be bidders for any of that, or will it all be platforms already? Will these be bolt-ons or platforms for private equity funds? What does the market look like, and who you sell into? What do multiples look like today? Is the market healthy? We're seeing some lower multiples in some areas, not so much in others. But what do you see out there in terms of multiples and who the pool of buyers looks like?
So great question. We've never seen a health system be competitive. almost always they feel like it should be an honor to sell to them just at the asset value, and so the valuations are, dramatically different, probably 5x between a strategic and generally a private equity backed strategic that's consolidating, and what you would see from the health system. So the health systems at this point are very effective at recruiting and kind of acqui-hiring, getting a practice that's small and marginal, and they want a better lifestyle. And so for them, they may make a little bit better cash flow within the organization and probably have a little bit better lifestyle, not doing the administrative tasks. But anything of scale outside of that, we have never seen them be competitive, and quite frankly, we've never really observed in the market anybody else going to them. In terms of the broader market environment, we all know about the interest rate environment, which I think is stabilizing, and there's hopes that it'll continue to go down. I do think though that the healthcare services segment is probably, relative to the other industries that we serve, been hit harder on the multiples front. And it's because I think of two things. One, the changes in the Medicare Advantage reimbursement program, particularly around risk adjustments, have really reduced significantly the PMPM that a lot of these value-based groups are receiving. And so I think that trickles down, throughout the system, not just amongst primary care groups, but amongst lots of specialties that ultimately are going to receive their money from the same, pot of money. I think the second is, quite frankly, just a broader concern. One of the few things that Republicans and Democrats really can agree upon is that they're not very comfortable with private equity in healthcare. And it seems like every day, whether it's a congressional hearing or with regards to New York Times article or Atlantic or whatever it is, the articles are not, very favorable. And so I think that kind of regulatory uncertainty and overlay is having an impact on buyers and their appetite, particularly amongst private equity groups that are industry generalists, right? There's a lot of groups that may do a lot of healthcare work, but they do other things. And so you see a lot of them shifting away from healthcare. The ones that are industry specialists and only do healthcare, I think that, you're seeing them, continue along. But I do think that the overall environment is shifting, particularly relative to, 2021 and what we saw just a couple of years ago.
No, 100%. And so the demonization of private equity in DC, at the end of the day, yes, private equity, like for example, in the Stewart healthcare situation, over-leveraged a moderate margin business, so that was a mistake. But demonizing private equity is kind of ludicrous, isn't it? I mean, it's fun for politicians, but I mean, so many pension funds, so many endowment funds, so many investors are in private equity, and it's just a capital game. It's a capital source. It's not bad or good. Do you have a perspective on that?
I mean, I agree with you. People always, I'll have some clients say, I don't want to sell to private equity. And it's like, well, let's unpack that, right? And, there's some bad actors out there and there's some great actors out there, right? And so just the same as, saying, well, I want to sell to a family office, you've got the full spectrum of types of people and their character and all of that. So I think you need to look at each one individually. But there is no doubt that kind of the general public, the way that they're exposed to it in the media, it's not not favorable. And interestingly, what you're seeing in some of the healthcare environments, you see is particularly in the veterinary space, is they're not publicizing that private equity owns it. They're making it very opaque. They're not putting it on their website as a portfolio company. And I think that's one of the tactics that some of the investors in the space are trying to use to minimize some of the backlash. But there is the Corporate Transparency Act that came through this year, and so I do think that that the level of attention is probably only going to stay the same or increase as as we go forward.
In terms of deals that you're looking at or bringing to market, how active is the family office portion of that in terms of looking at investing? What's that breakdown versus, private equity funds looking at buying a platform, private equity funds using one of their sponsored companies for a bolt-on versus a family office being in the hunt. What do you see out there?
So, most people describe a family office as the Goldilocks buyer. And for some people, it could be, perfect. The reality, though, is that family offices, with the exception of a handful that are basically institutional funds, like, MSD, which is Michael Dell's shop, or there's a handful of others, are generally a marginal buyer. The challenge, particularly as an investment banker in the space, and I have discussions with some of my colleagues in other firms about this all the time, is for every family office that actually makes investments, there's probably 19 that like to talk about making investments but don't, right? And they're generally not well equipped to be able to be competitive on the timeline, kind of the shot clock that's normally associated with a transaction, right?
But your point is so well taken, though. Your point is so well taken, because most family offices are building a portfolio, but they're not in the constant business that private equity funds are, of buying and selling companies and growing companies and sitting on boards and so forth. I mean, your point is very well taken. There's very few that are really that equipped and that large scale that have built out the teams to really do this in a really substantial basis. We've talked to people that have family offices of 500 to a billion, and they just can't really do this at the scale and pace that well-funded private equity funds can, and well-staffed private equity funds can. You just can't do it. And there's not that many, there's 400, 700 billionaires in the country. There's just not that many private equity family offices that have the size and scale to do this well. Is that a fair statement?
Absolutely. I would say that, in terms of being able to actually systematically do private equity deals in the U.S., my best guess is that there's probably no more than 50. And there's probably a universe of 1,000 family offices that exist. But, the other factor, which a lot of people don't realize, I get clients all the time that say, I want to sell to a family office. They hear about it. But, and this is purely anecdotal, but, based upon my experience and a lot of the other folks that I talk with, in general, there's about a 15 to 25% discount on valuation from family offices when you run a process, has been my experience, right? So there's certain situations where somebody really cares about legacy and the dynamics and all of that, and a family office could be that best source. And family offices in some segments may be the only potential buyer, right? There's certain industries like certain types of distributors or franchises where approval is required and private equities can't get approval, right? But by and large, because they tend not to use a lot of debt relative to their institutional counterparts, you tend to see materially lower valuations. And ultimately, I personally think that the way I advise my clients is, let's go out to a little bit of each of the different categories, and you get a feel for not just the price that's being put on the table, but also what are the other intangibles that you can then choose from, right? And there's no right or wrong answer, right? Some people choose to go down the ESOP route, and that is not because it's the best economics, but it's because they have other factors and things that they want to accomplish with a transaction, like rewarding key employees. So it's it definitely is a relevant buyer. Where I do see family offices being much more relevant is in the smaller segment, particularly in growth capital. You do see a lot of people, and whether you call them family offices or not, ultra high net worth individuals who may have sold out from that industry, tend to be excellent providers of growth capital or minority investment for companies that are subscale. They already know the playbook. Quite frankly, there's not a lot of institutional capital that's available for that. And so you do see, for example, in healthcare space here in South Florida, there's 3 or 4 guys, each made $500 million to $1 billion through different, healthcare services exits. And, they're out deploying and using their relationships and capital to help, do the private equity playbook with younger groups in the community.
So I've got a few different questions that sort of roll from that, and I'll ask you Dr. Chen, Chris Chen and his team, are they one of those big investors that do some of the smaller deals in South Florida who've just done fantastically well in Chen Med and also serve on the board at University of Miami Med School and so forth? You run into the Chen family doing those kinds of deals.
So I'm not privy to the specifics that the Chens are doing. Most of them that I've seen tend to be people that have exited the business. They're not currently operators, but from their vantage point, they don't want to retire. They have a lot of know-how. They have a lot of relationships, and for themselves, they can generate substantially above market returns than what they could get, just being passive in a portfolio.
Yes, because they really know the business. They really know the area. I think that's really well stated. I'll ask you a very sensitive question, and you don't have to answer this, David, if you're not comfortable answering it. So I'm going to give you two different Harvard Law School classes, and you'll tell me which is the better class. Okay, and this is sensitive, and if it's too complex for you, don't answer. The class of 2007 or the class of 1989, which is the better class at Harvard Law School?
Without a doubt, 2007. We had the first ice skating rink installed during our tenure. So I think I'm going to go with 2007.
So that's clearly the winner then. We had Anthony Scaramucci, Rod Rosenstein, Barack Obama a couple years after us, and so forth. So there's at least some argument that there's an interesting contrast and so forth. David, I'll ask you another question, a real question. What was your favorite class at Harvard Law School? Do you have a favorite class or favorite professor or anybody that you particularly enjoy taking from?
It's funny. I don't know if you had David Rosenberg, but he was our property professor, and in a lot of ways, he was the most atypical professor that I've ever had. He didn't teach a single case, but he did reframe a lot of things. He challenged a lot of things that we took as assumptions, and I think was one of the most fun classes that I had. I don't know if he was around when you were there.
I'm not sure. There was a different Mort Rosenberg, who was a tort professor, who was a famous tort professor, but I don't remember David Rosenberg property. I didn't have him, at least if he was there and so forth. Tell us, one last question. What are you most excited about and focused on this year? When you get up in the morning this year, what drives you? What are you most excited about looking at and doing?
So for me, there's just tremendous opportunity here in the market. So it's really around scaling my organization. We have a lot of demographic tailwinds. You think about the reason why healthcare everybody's excited is the baby boomers retiring. Well, that's the same factor that drives M&A, right? And so, some markets are better than others, and we definitely have had a much harder time in terms of the selling environment today than we had a couple of years ago. But the pipeline is significantly greater than it was, and I think there's just a lot of backlog of retirees. So we're excited to talk with them and excited to help them, achieve full value for their life's work.
David, what a pleasure to visit with you today on the Becker Private Equity Podcast. What a complete pleasure. Thank you for joining us today. We'll get this out next week, but really a pleasure to visit with you.
Yeah. Thank you, Scott. I appreciate it, and enjoy your weekend.